Welcome to this Killick Explains video about gold, and advanced apologies for the fact this is another lockdown format style video. Hopefully I shall be back in the studio once the rules allow. So, 5 things for every investor to know about gold, particularly beginners thinking about whether and how to get some exposure. So as usual, a few background points first of all. Now, a lot of people will know, watching this and listening to it, that the gold price has been moving up during 2020. Indeed, it's flirted with the $2,000 per ounce level, and for novices, gold is priced in US dollars. This reflects a renewed interest in it as an investment and or a hedge. More about that in a moment. So here are a few things worth knowing, particularly if you've not invested in gold in the past and were contemplating doing so. First of all, the physical properties of gold are partly what makes it attractive as a potential investment. So it is a precious metal. The others, well, there are 2 that you would make a wedding ring out of, those being silver and platinum, and 1 that you wouldn't, palladium, used amongst other things in catalytic converters for vehicles. Gold has industrial and cosmetic uses, which makes it attractive, as many people will know. The industrial use is less well known perhaps than the cosmetic jewellery ones, and it has a limited supply, unlike the major currencies in the world that can be printed, seemingly ad infinitum, and it can't be manufactured. So it is a limited supply, and that supply is known and trackable. Now, what about its investment properties then? Well, it pays no interest. For some people, that is an immediate drawback. It makes it quite difficult to value. There's no dividend stream to discount as there is with, say, equities. There's no coupon, there's no dividend here. But it can offer a capital gain, and it shows historically a low correlation with other asset classes, in particular equities. So there's a feature that can make it attractive to a certain kind of investor worried about what's happening in the world and what may happen to other asset classes. Now, price influences, well, supply and demand. As I said, supply is finite and largely known, so demand up and down will tend to move the price, as you'd expect. Specifically, fear. Gold has safe haven status. It has traditionally been somewhere that people look for safety in an uncertain world, and historically it has shown some ability to combat inflation, particularly at a time where currencies are being printed. Those people who see inflation coming down the pipeline as the supply of money, if not its immediate velocity, increases, see gold as a potential hedge. And the charts reveal historically there is some grounds for thinking exactly that. Now, ways to gain exposure. There are a number of ways to gain exposure to the gold price. There's the obvious one, which I'll cover in a moment, and then 2 less obvious ones. So let's take a look at that. First of all, there is physical gold itself in the form of jewellery, obviously, bars and coins. Then you've got the gold mining shares, so a slightly indirect route in, if you like. And then you have gold funds, such as ETFs and ETCs, that's exchange traded funds and exchange traded commodities, as the commodities branch of the ETF world is sometimes known. Now, these all have various pros and cons as a route into getting exposure to gold. So considerations would include the ease and cost of transacting in each case. Physical can be a little bit more difficult and expensive than either, say, gold mining shares and or ETFs and ETCs. So watch out for the fact that if you are trying to buy physical gold in the form of bars and or coins, there are normally dealing, storage and insurance costs to weigh up. But then set against that, if you like, you've got the tracking error, which you get in particular in relation to gold mining shares. People are sometimes surprised to find that gold and gold mining shares can go in almost opposite directions, and that's because gold miners are some distance from the gold itself. There are other factors that influence share prices. Now, Gold, exchange traded funds and exchange traded commodities ETCs on the other hand can give a reasonably accurate exposure to the gold price without having to get involved with holding and storing physical gold, and typically they're a fairly cheap way in. One thing I would, however, note is that some of them are backed by physical gold, others are backed by derivatives, and therefore the extent to which you get gold price tracking may vary, and that's something to investigate as an investor. So point 4 here is tax efficiency. And this is often a question that people ask if they're thinking about investing and using up their individual savings account allowance or holding something within a pension, so a self-invested personal pension. So, first of all, physical gold can attract capital gains tax unless it's held as coins on the basis that currencies are not normally subject to CGT. Income tax isn't a problem in the sense that there's no income from physical gold. Gold, however, is not ISA eligible in its physical form, but it can be held within a self-invested personal pension. Now, the fact that physical gold can be held within a SIPP doesn't mean that physical gold is the best way to get gold exposure within a SIPP. That would be the tax tail wagging the dog, as it were. A better way to think about this is what is the most efficient, liquid, cheapest way for me to get exposure to gold, and that may be via something like an ETF or an ETC, and then can I hold it within a SIPP or an ISA. Now, fifth point I want to mention, there are others, but this is an introductory video, is gold as a holding. Just some points to take away. So, some investors do like to hold gold as a form of insurance. It has shown in the past its ability to hedge against inflation, to hedge sometimes against what's happening in other markets, such as the equity market. The price, however, in the short term can be extremely volatile, and that's something to bear in mind. Whilst the price has generally been moving up during 2020, it can suffer sudden short downdrafts. That's true of equities too, but it's worth bearing in mind. And normally, gold would be considered as a small percentage of a portfolio. I certainly wouldn't recommend a novice to pile into gold. It's as dangerous as single stock investing. You want to be diversified across asset classes, and normally a small percentage of a portfolio in gold, yes, can act as a form of portfolio insurance, but in most cases you wouldn't want much more exposure than that. Any questions on what's a fairly big topic? editor@killick.com. And if you'd like to watch other videos that talk about diversification, talk about asset classes, and actually talk about gold too, then killick.com/learn would be a good place to start.